When you buy real estate, you are buying both the land and a building. The land is not depreciable, but the building, the concept is that as it gets older, it's worth less. And the government has this thing called depreciation, that they allow you to take a deduction as if it was an expense for the loss of value of the building. And it's usually 3 to 4% a year of the value of the building. So you buy $1 million worth of property, your accountant will say, let's say 200,000 was for the land. I can't do anything with that, but I got 800,000 that was for the building, and 3 or 4% of that will be a deduction every year. That's the basic and the standard. But very few people know that if you can do a cost segregation study, you hire some engineers and they do this study that they say, well, the 800,000 isn't all building. The 800,000 includes an air conditioning system that depreciates in 10 years or 15 years, or the doors that depreciate in 5 years, or whatever it is, so that all the components that you're buying, there's an allocation of that $1 million where it's going. And some of those components, the depreciation deduction you could take in 5 years. That means if certain set of components total $100,000, you can now take $20,000 of those components as a deduction. And that really reduces your income tax liability and so forth. When you put it all together, what that means is, on average, as a rule of thumb, you invest $1 million, you buy $1 million building, and you usually will be able to take a $200,000 deduction using a cost segregation study. Now, if you're buying that building with 20% down and you're getting 20% of the value of the building, of the entire million, then you're getting a 100% deduction. Let me repeat that again to make sure people understand it. You buy a $1 million building with $200,000 of down payment.
Okay.
But your deduction on that building is 20% of the million. So your deduction is 200,000. Your deduction equals your down payment. So basically, you've made, let's say this year, you made an extra $200,000 beyond what you need to live. You could take that 200,000, buy a $1 million building with financing, and that 200,000 gets completely deducted from your taxes. Now you have $200,000 less to pay tax on. So those are ways that you could certainly save and turn this into an opportunity.